Welcome to this presentation on variable versus absorption costing as part of Stratfield Solutions' Understand Managerial Accounting in 5 Minutes mini-series. Today we're going to look through this topic that's very common within managerial accounting, and it really looks at the different types of costing methods that a firm has when it's preparing its internal costing reports. So again, this is a relatively common topic within managerial accounting. It's found common in textbooks as well as with decision making that a firm has to decide as to which way they're going to record their cost related to production of goods. So really this difference is looking at the way a company records its fixed overhead cost. And again, if you don't know what a fixed versus a variable overhead cost is, check out one of our other overhead and costing methods courses, and it'll walk through the difference between a variable cost and a fixed overhead cost. So in this variable costing method, the direct fixed overhead costs are separate or separated from the other direct cost of production. Whereas under absorption costing, the direct fixed overhead costs are absorbed within the other direct variable cost. So what we have is essentially two methods. At the end of the day, they both produce the same net income, but it's a matter of how you treat the fixed overhead cost of the firm. Are they put in with the other cost of production, or are they separated out? We'll go through a full example at the end to show you what a statement example will look like of the two methods. But you may ask, why is there a difference? Well, companies generally like to have more detail behind numbers. So being able to see which costs are fixed versus variable, especially when it comes to a manufacturing overhead type of process, is important. However, the problem is the detail can be obtained with variable costing, but the method is not acceptable under the generally accepted accounting principles in the United States. There's other reasons as well for incorporating all of the manufacturing cost, including that fixed overhead. And we cover this topic in our full course on variable and overhead costing at stratfieldsolutions.com. If you need more detail as to the theory and methods of why this difference occurs, feel free to check out that course there. But today we're going to talk through just the differences between the two methods and what it looks like on an income statement. So some other notable differences between the two methods. If you see contribution margin, well, you're dealing with variable cost. This is selling price minus variable cost. You can't get to that level of detail at contribution margin in absorption costing because the variable and the fixed cost are put together, and so you do not have this analysis of selling price minus variable cost. So if you see contribution margin, you are dealing with a variable costing statement, whereas gross profit is a concept under absorption costing. That is equal to sales minus cost of goods sold. Again, the cost of goods sold is inclusive of both variable and fixed cost. Variable costing is sometimes called direct costing, meaning we're dealing with the directly the difference between the selling price and the variable cost. Again, that's contribution margin. And absorption costing is sometimes called full costing, and that shows the full amount of direct cost, including the fixed cost of production. Finally, of course, in either variable or absorption costing, direct materials and direct labors are included. So two other quick notes: selling, general, and admin costs, SG&A, are always separated from the product cost in either method. Those are non-product costs, also known as period cost, and so they are still separated in either of the methods. And then service firms, those that do not produce a physical product, generally are not as concerned with the topic because you do not have a product cost if you're only producing services. So full example here on the left side, what we're going to do is look through the variable or direct costing, and you'll see our sales, variable manufacturing cost, variable selling, general, and admin. Again, that's separate from the one above it. This gives us that contribution margin. So sales minus the variable cost. We subtract our fixed manufacturing and our fixed selling general, and that'll give us the net income of $3,000 in this example. So again, you can see how all of the costs are separate. The variable and the fixed are separated from another, and the selling and general admin are also separated. On the right side, we go through the full costing. So again, the sales is the same amount, no change there, but here's where the difference appears. The cost of goods sold includes not only the variable manufacturing, but that $5,000 of fixed manufacturing overhead costs that we see on the left side. So the total being 30 of variable, 5 from fixed. This gives us gross profit, sales minus cost of goods sold. We take all of the selling, general, and admin, both variable and fixed, and subtract that out. And sure enough, as mentioned earlier, the net income in either method is the same. I hope that presentation was helpful for you, and if you need additional resources for either financial or managerial accounting, check us out at stratfieldsolutions.com. Look forward to seeing you in another video soon. Thank you.